Welcome back everyone to yet another module on options trading. In the previous two modules, we discussed about the basics of options and various options trading strategies used by investors. Before we start, I would urge all of you to go through those two videos before watching this one. Investors who understand the factors that impact option prices are well suited to navigate the dynamic world of options market and take informed decisions, and also use the options strategically for the risk management such that they enhance their returns. Hence, it is important to understand the factors that affect the options prices. Let's try to understand these factors through an example. Suppose there is a stock, hypothetical stock, that trades at rupees 100 with annualized volatility of 20% and it doesn't pay any dividend. Also suppose that the risk-free rate prevalent in the market is 5% and an investor has purchased a European call and an European put option on the same stock with a strike price of rupees 105 and the times to maturity of 6 months. Now suppose, keeping everything else the same, the stock price increases from rupees 100 to 110. Due to this change, the stock option position of the investor will become more valuable because as an holder of this call option, the investor has an opportunity or a right to purchase the stock at rupees 105, which is 5 rupees less than the prevailing market price, which increases the value of the call option, hence the premium of the option goes up. On the contrary, the put option position of the investor goes down because as an holder of the put option with a strike price of rupees 105, the investor has a right to sell the stock at rupees 105, which is again 5 rupees less than the market price, which decreases the value of the put option and hence the put option premium goes down. This example illustrates that the stock price is one of the important factors that affect the option prices. Now again, let's go back to the same previous example and this time change the strike price of the both European call and European put options from rupees 105 to rupees 110, keeping other things the same. Due to this change, the new call option will become less valuable because it is more attractive to buy a stock at rupees 105 rather than at rupees 110. So the call option becomes less valuable. On the contrary, the new put option will become more valuable than the old one because it is more attractive to sell the stock at rupees 110 than at rupees 105. So the new put option will become more valuable and the put option premium will go up. So this example illustrates that the strike price is another important factor that affects the stock option's value. As the strike price increases, it makes the call option less valuable and the put option more valuable. So now let's move on to another factor. Stock prices are volatile, which means that there is a lot of uncertainty about the future movement in the stock price. So if in our previous example, if we increase the stock volatility from 20% to 30%, which means that the probability of stock doing either very good or very bad increases because of this increase in volatility. Due to this increase, the call option position of the investor will become more valuable because as an holder of the call option, the investor gets benefit when the stock price does well, whereas it faces a very limited downside risk due to a bad event happening in the stock market. Because at worst, investor will lose the premium paid. Hence, when the stock volatility increases, it makes the call option more valuable and the premium goes up. Similarly, the put option position of the investor will also become more valuable due to this increase in volatility, because the investor will get benefit when the stock price goes down but faces a very limited downside risk when the stock price does well. Hence, as the volatility increases, both the call option and the put option becomes more valuable and the premium goes up. This example illustrates that the stock volatility is another very important factor that affects the call option and the put option premium. Now, in our previous example, let's change the time to expiry from 6 months to 12 months for both the call and the put option and keep everything else the same. Due to this change, the stock price gets higher time or a larger amount of time to move in the favorable direction. That is, the stock price gets a better opportunity to move up, which makes the call option more valuable, and at the same time it gets a higher opportunity to goes down, which makes the put option more valuable. Hence, when the times to maturity increases, both the call option and the put option becomes more valuable and the premium increases. And this example illustrates that the time to maturity is another factor that affects the price and the premium of the options. Now let's move on to the next factor that can affect option prices, which is risk-free rate. Risk-free rate is the rate of return that investors expect to get on a risk-free investment, for example, government bonds. The impact of changes in risk-free rate on the option prices is less clear-cut, because on the one hand, when the risk-free rate increases, generally the stock prices goes down, which makes the call option less valuable and put option more valuable. On the other hand, when the risk-free rate increases, it decreases the present value of all the future cash flows that the option investor can get, which makes the call option more valuable and the put option less valuable. Hence, the impact of change in interest rate over the call and put option premium depends on the relative strength of these two factors. This example illustrates that the interest rate is one of the another important factors that can affect the call and put option premium. Now, in the last, let's go back to our previous example and assume that the stock pays a dividend. Generally, when the dividend is paid on the ex-dividend date, the stock prices goes down. This is a good news for the put option holder, but a bad news for the call option holder if the ex-dividend date lies in the life of the option. So, when the dividend is paid, with the amount of dividend, the call option premium is negatively correlated, whereas the put option premium is positively correlated. This example illustrates that the dividend paid is another factor that can affect the call and put option premium. Now, to summarize, there are 6 factors that affect the call and put option premium. First, the current stock price. Second, the strike price of the option. Third, the stock volatility. Fourth, the risk-free rate. Fifth, the time to maturity. And sixth, the expected dividend on this stock. With this, we will end this module, and thank you for your time and attention.